Welcome to the Dividend Talk podcast, episode 214. Four dividend stocks to capitalize on China's economic revival. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How are you, buddy?
I'm quite okay, I must say. A very busy week again, but a little bit more normal than I had in the last few weeks. So yeah, I feel quite energized. How about you?
Good. Pretty much the same. It's look, it's Ireland winter starting to come in. We're in this strange period where it would be sunny for about an hour and then it'll just rain really heavy. Like it's like this crossover between summer, an Irish summer and winter, and it's quite an awkward time to try and even dress appropriately for it. It's quite strange. But hey, look, it's what we're used to here. So ain't no point complaining about it anymore because someone in Finland will give out to me.
Well, autumn is starting. The days are getting darker. So it's about time to speak much more about dividends again, right? Here.
Yeah, exactly.
Look, it's really simple, right? We can talk a lot about the weather and everything actually, but there is something here that I want to discuss, and that is BASF. Did you know that they updated their capital allocation policy and with that reduced their dividend from €3.40 this year to €2.25 next year? And it's all part of a new plan because they expect to make 12 billion in the upcoming 4 years. And yeah, what they are saying now is like, we want to pay 8 billion over that time and have 4 billion left for, share repurchases. Specifically in the 4th year, they want to start that. And we have been telling about this already in episode 180 something. I put it on Facebook as well, little snippet. We knew that the current dividend run rate was 3 billion per year. So they would have no money left at all to do anything. Nothing can go wrong.
Yeah.
And that's a big issue, of course, for a company as BASF. We were expecting a dividend cut. The dividend cut happened. So, I mean, kudos to ourselves. I mean, sometimes we are missed, but this time, this one, we have been definitely right. And yeah, very interesting one. So also the World Investor was asking, like, why am I selling BASF now if I already have the principle of selling a dividend cut? Okay, he understands it, but why didn't I do it with Shell? But otherwise, China will be recovering. So aren't we selling at the bottom?
Yeah, it's an interesting question to have. I mean, I think six months ago, even 9 months ago, if we go through those quarterly reports, they've been hinting at a dividend restructure and a dividend cut. We know back in 2022, their free cash flow was 3.3 million. It was only 2.7 million last year. So you can already billion. Sorry, so it was already in decline. It's already under pressure, and as you said, with 3 million or 3 billion to be paid in dividends, it was never going to be sustainable. So look, I think a dividend cut was always on the cards. We called it on the show. I think a lot of people expected it as well, and I think it's actually quite sensible for management here to cut that dividend. Asking the question, why would you sell it now? I think it's nearly too late. At this point, I think the time to do it was maybe 6 or 9 months ago. I believe I sold it 9 months ago when I got a wind that they were likely to do it. But I can see
I was very clear in that, right? I wanted to sell it later this year. Like I was always thinking around May, June, after the dividend being received, because I didn't feel like in a hurry. So then the summer kicked in. So this was a good reminder to me to think about BASF again. So I sold a few shares today. I will sell a few more in the upcoming weeks to just round up the I said to just sell out on it and buy something else in return. But I'm really not in a strong hurry. I'm selling it, of course, because of the dividend cut. I never had a strong conviction about BASF. And when it then cuts to dividend, I want to get rid of it. The difference with Shell is that I do have a strong conviction in Shell, and I found it very useful that the company do it. Maybe not very useful. I felt they had to do it because they had this pressure of not having cut the dividend since the Second World War at the time, and it was just not sustainable. We could all see that. But I see Shell in a total different business than in BASF. I see BASF has structural problems that will be there for years to come. With the gas prices, also with Ukraine. So, and I see this differently for Shell. I saw that Shell at the time was in the low teens. Come on, guys, that was a steal. At the bottom of COVID. So now it's just a hold. Why sell? The dividend profile has changed significantly and is a very strong and solid dividend profile. I mean, they're buying back shares for 5% annually at the moment. They can easily cover the dividend. The balance sheet is in a really good situation. So for me, it's not comparable to BASF. And at the time, I was really pounding the table on Shell due to conviction. Knowing the industry a little bit better, probably also than what BASF is operating in. But it's a pity. It's a German company again. If you think also about Volkswagen, what's happening there with the 330,000 people or 300,000 people, 30,000 people that they want to fire. I mean, I don't know what's happening in Germany. We spoke about already in the last show, I think, and I think we even have a question about it later in the show. But it's just no fun at the moment, I think, with the German industry.
They're quite struggling at the moment. But interestingly, Germany historically, or at least over the last 15 years, has high amount of export into China. So you'd wonder, will that have a little bit of a positive impact on Germany? I don't know.
We'll discuss it maybe later. It may be a value play, but I want to stay away from those. So
dividend hikes. What has been on the radar this week?
Well, first of all, Honeywell hiked their dividend by 4.6% today, and Honeywell is one of those underrated companies that not many people speak about. So I just want to say kudos to them. I think it's the 14th hike in annual hike, but the big one is, of course, guess which one? 48 consecutive dividend hikes in a row, hiking the dividend today or yesterday by 6%, making it $1.77 per share, $7.08 annually. Which one is it?
The Golden Arches.
Yes, McDonald's. I mean, good, really good for them. I'm not an owner. I was once an owner. I shared that once in the mistakes that I made, that I thought that it was overvalued, so I sold it. That's something that I'm therefore also not doing anymore. I bought it at 90 and sold it at 120, thinking, I made a nice profit. Nobody ever got poor of making a profit, but one of those learnings.
Yeah. And of course, it's one of the companies we mentioned a couple of episodes when we were talking about interest rate cuts and who could benefit, and McDonald's could be a clear beneficiary of
yes.
that. In part because half of it is like a real estate investment trust, even though it's not. It has a lot of real estate. And then, of course, when people have more discretionary money, some places like McDonald's tend to do very well. So kudos to them. 48 years in a row, nearly a dividend king. 2 more years and it'll
True
reach
that. They will make it. They will make it. No issue there.
Okay, so this week our topic is around China. No surprise, really. We got a couple of questions on this. Joe's broke dude said, "Thank you for last week's answer, but with the latest developments in China, which dividend shares are on your shortlist for China/Asia?" And Omar has asked us to comment on Alibaba. So, of course, there was big news coming out of China. We know that they've been struggling with a weak consumer, with a weak economy of late. So not ones to sit back, they're trying to stimulate the market on that. So just a bit of a blurb that I got from Reuters, but what they are trying to do is they're trying to inject some liquidity into the banking system by lowering the reserve requirement ratio by 50 basis points, which will release roughly 142 billion of liquidity into the market. So this is trying to help them achieve their 5% economic growth target, which I think is actually quite low for China, considering that they had 3% during COVID when the place was closed down. So I think 5% is still low, but that's how much they are struggling. As part of this package, they are expected to issue 2 trillion yuan, which is roughly $284 billion in special sovereign bonds. And that's to support physical measures to like boost their economy. So that's going into housing, into industry, to just try and boost spending and try and stop people saving money and spending a little bit more and getting their economy back. So this news has filtered out, and I suppose people are getting a little bit excited. We were talking about companies like Louis Vuitton, and I'm sure we'll talk about them earlier, whose thesis is around China and how we are concerned about that. So this news obviously is going to impact some of these types of companies. So I'm looking forward to hearing your take on some companies that might benefit from these. So we'll get to Joe's broke down answer shortly, because we'll pick a couple of companies each. But I'll start because we mentioned this company in the news of the week, and it is BASF, which might be quite surprising, but I think the question hit the nail on the head. The World Investor said, China seems to be recovering now, so are we selling at the bottom? And that's a very good question, but I don't think it's any surprise that China is at the center of BASF's policy. One of their board members has come out on record saying that the Asia Pacific region is their #1 growth engine for the chemical industry, and China is actually 70% of that region for them. So you can see how important that is to their strategy. They first entered China way back in 1885. So they have a long-standing relationship with China, but it's not really until the 60s when they started building up their interest in there. Their first site went in there in 2005, this Verbund site, which is basically just like more efficient site that joins all their components together. So I think they have 2 or 3 Verbund sites now, but it's the third one that's ongoing at the moment. And I can't even pronounce it. Zhang Yang or this. yeah, you get it. But this new one, that's where all that cash flow has been cut up over the last while, which we've seen the effects of that in terms of the dividend cut. But we can see now maybe it's a smart move if China are trying to stimulate the market. If we have industry growth, it's going to need more oil, it's going to need more gases, and I think there's opportunity for them to grow. So I think that's why it's pivotal to BASF. I know they've cut the dividend, and Europe has been stronger in terms of the revenue growth over the last couple of years, but China is their second biggest. And if they are recovering and they are requiring more gases and more of their products, then I think there's definitely room for them to grow, and especially now after they cut the dividend, because I think that was necessary. I think it would have been worse if they held the dividend, considering their free cash flow constraints. They've given themselves a little room to breathe, and if we see China recover, it might be a similar I won't say it'd be as good as Shell, but we know Shell got very fortunate when they cut the dividend. Then we had COVID, and then after COVID, prices went through the roof, which helped their free cash flow. We could
Yeah.
see a lower scale of this with BASF, and hopefully then allow them to continue growing that dividend at a smaller rate. But I see some potential here.
Yeah, it all sounds nice, but for me, it became a value play now. Otherwise, yeah, a turnaround play or something like that. And it's a pity. I really feel always pity with these European companies. It's not that they are doing not the right thing. Yeah, don't get me wrong, because I think you should always protect the balance sheet. Yeah, it's just a pity that that they couldn't somehow keep it by having a better business. But I think really here the German government also just kind of put the company in trouble here, because with their regulation, what they're all doing, also when they switched all to what was it, kill the nuclear and everything, then the deal with Russia on the gas. I mean, there was not a lot of strategic foresight there, and it hits this company very hard. And that's why we were kind of also both of the opinion that this dividend is not sustainable. We were actually surprised a little bit that at the time they kept the dividend. So for me, it's kind of okay. I'm selling it. I sold already some shares. It's kind of okay. Next page, book closed, chapter closed, move on, forget about it. So
Yeah. I don't think it's as much of a turnaround play as Walgreens or Intel, if I'm honest.
yeah,
You still get rewarded with a 5% dividend yield at current prices. So the
yeah,
dividend is still quite, I would say, risk to reward is healthy. I don't think it's too bad. You can't call it a dividend growth stock anymore, but certainly if China rebounds, there's strong
yeah,
potential for the share price to rebound as well. So the total return
yeah,
might work out better. But yeah, I think in terms of China revival, I think BASF could be at the heart of that, and it's good
yeah.
news for them, especially with what goes on in Ukraine, which hit them hard as well.
Good. Hey, let's talk about a nicer stock. And I want to talk about Louis Vuitton, LVMH, ticker symbol MC, trading on the Paris Stock Exchange. Unfortunately, for most of the people, they might be late already, because just in 2 or 3 days, this company went from 620 or something like that to 700 today. So they may have already missed the China bump in the share price. But look, I was actually, in preparation of this podcast, I was listening back to the half-year results to understand what they really say about China. And it's interesting to hear the CEO speaking about it. So first of all, they felt the biggest hit in the first quarter already. So in the second quarter, it was a little bit of a similar story there. But what is interesting here is when they talk about geographies and international footprint and such, they actually talk about the mainland Chinese consumer. And generally in the fashion and leather business, they were growing high single digit. But the business area that was hit really hard was the jewelry and watches business unit. And this is where they really felt the pain of the Chinese consumer. But I do think that the analysts, when I heard them talking all the time about China, and I heard management's answers, I had a feeling that the analysts were maybe looking for a narrative that, oh, this company is going down because of China or something like that. It was very, very interesting to hear this Q&A from that point of view. And maybe that's also why the share price goes up now so much in response, due to the analysts now thinking like, okay, the China problem will be solved. Let's bump the share price up. But honestly, management has been quite conservative here, and actually not ringing the bell saying like, oh, it's all bad at the time. And the numbers didn't support it that much. Yeah. What is good to know is that if you think about LVMH, Asia at the moment is the largest geographic area. It makes up 34% of entire revenue. It has also been the highest growing area, because this wasn't the case yet in how is it in 2018 or something like that. It was slightly below 30%,
Yeah.
but it has been bumping up quite quickly. And when we say here from 29% to 34%, we're talking about billions here. It has also been, over the last 10 years, the fastest growth area with 13.8% CAGR. So each year in revenue growth. United States was 12%, so much more than and further down, then much more than the other companies, which were more countries which were more like 8 or 9%. So clearly, China has been the growth factor for this company over the last 10 years. There's no doubt about that. So a weaker consumer does impact, logically, Louis Vuitton, even though management was mentioning, not to that extent, not so much as maybe the analysts wanted. But yeah, I'm not surprised that the share price is already back at 700. This then poses an interesting question, right? You should have held LVMH and bought LVMH anyway if you were thinking that the Chinese consumer would recover. You had half a year a chance almost to buy it in the low 600s. The good thing is that I think last week's the share prices were really dropping from LVMH, and many people on social media and on Facebook were mentioning that they were buying LVMH. So I think a lot of our listeners have been very wise in the last week to buy it when it was really going to the low 600s, and they've made a really quick buck just from a capital appreciation point of view already in just 2-3 days. Yeah, because share price went up by almost 15%. But that being said, I do think that you're already too late for LVMH. Yeah, it can still grow. It can now start accumulating normally again. But I think the China bump is now already priced in this share price.
Yeah, no, I agree, and hindsight is 2020, as I've often said on the show, because it wasn't too long ago, maybe a couple of episodes ago, we spoke about these, and
Yeah,
I didn't have enough conviction in China, and that's the problem. You're relying on a government and markets that we're unfamiliar with. Their cultures are different. Their
yeah,
outlooks are different than us over in the West, and you don't know when they're going to recover. But it's actually funny that when we were doing a little bit of research on this topic, how the CEOs of the companies that we are mentioning, or the board members, how bullish they were on China even during that time. So maybe there was a hint there, but I didn't have enough conviction
well,
in China.
bullish, I wouldn't call it bullish, but they were not so negative as the analysts were, or not so concerned. Let's call it like that. Yeah.
Yeah.
But no, this is very interesting. And how to say it? For me, with Louis Vuitton, it's a company you just need to own and not trade it. And this is a classical example of when you are not all the time in the market and miss out the two most important days in the year, you miss out most of your total return. Yeah, there are these statistics that if you miss the 3 or 5 most important days in the year, you only have half of your total return. This is a classic example what we've seen this week.
Yeah, I think you'd be kicking yourself if you were trading any of these stocks and sold it and buy back in before that news happened. And that's the problem with trading sometimes, especially with news like this. It can almost wipe out your expected returns in no time. And all these companies, BASF jumped about 6 or 7%.
Yeah.
Louis Vuitton jumped about a bit higher than that, about 9 or 10.
Yeah, 15 in total, I think. 15, yeah, but what it all means, right? What people shouldn't forget, the stimulus that has come from Chinese government, that requires almost a year to trickle down into the economy. So it's not like tomorrow suddenly everyone starts to party like there's no tomorrow in China. No. This money needs to flow through the system, and when you know that it comes from the government, it always goes slow.
Yeah. But you know how these analysts work and how it will go in the next investor relations when they have their presentation, it'll all point to its future growth and it'll point towards China. And everybody will be happy and have that feel good factor and it'll keep the share price elevated.
Well, show me the money, I would say, like Jerry Maguire.
Show me the money. Yeah, nice one. I completely expected Louis Vuitton to be on this because we spoke so much about the Chinese reliance on them. But one company I wasn't aware the reliance in China was so much was Siemens, which look, it makes sense that they should be. They're involved in everything in terms of automation and infrastructure. They also had a nice jump from 165 euro up past 182. So they had a nice jump out of this as well. But I was speaking there about CEOs being bullish, and you said they're not being that bullish. Well, if you go back 4 months ago, and there's a YouTube clip from their CEO, Roland Bush, and he was getting challenged about China. I think they were investing about 140 million in some infrastructure over there, and the question was why, with the weakening demand over there and the weakening consumer. And he was very, very strong in his conviction, saying China is in a tough moment, but give it a couple of quarters. And his exact words were, no doubt China will come back. So he was very, very bullish on it. And that was only 4 months ago. So maybe it's happening quicker than he expected. But yeah, it was quite interesting to hear him say that and see how he got challenged. But Siemens again have a long history in China, but way back as far as 1985, and they've been growing there ever since. And it actually makes up for around 25 to 27% of their overall revenue, which actually surprised me. I forgot it was that much. And I know we looked into them just a few years ago, so I forgot it was actually that much on them. And they've been doing so well over the last 12 months that the China effect didn't really impact them because all their other regions were growing except for China. China was down about 19% last year, which is quite a big chunk, especially when it's 25% of your business. So look, I think it's a no-brainer. They're looking to improve their infrastructure. Siemens are all over that. They're looking to improve their industries in terms of automation. Siemens will be all over that as well. So I think the digital industries, which had a negative outlook last quarter, will definitely have a positive outlook in the next couple of quarters and will drive this share price up. So I think Siemens is a strong contender to benefit from China. And I always say this, but I'm kicking myself. Honest to God, I'm kicking myself that I did not buy more shares when it dropped under 100 euro.
Yeah, well, it is like this, Derek. I must say, Siemens, for me, you know that I'm a big fan of this company. I just was complaining about German economy, but this company is somehow standing out from it, which is really refreshing to see. And yeah, good news for them. Once again, it will take some time for this money to trickle down into the economy, but it is, of course, really nice to see. And yeah, for me, Siemens should actually crash down a little bit. So to your point that we can buy more of it.
Yes. Come back down with the rest of Germany and give us a chance to get more.
Exactly. And then we have a company that I just wanted to highlight, which is very interesting because Starbucks is also having a lot of sales coming from, from China. If you think about the store count, I don't know exactly what the percentage is, but it must be something like 15 or 20% of the entire store count that is coming from China, and it's always been the biggest growth area over the last few years. So it's very interesting to see that the share price didn't really respond to it. It may be because it already got a high bump because of the CEO coming in and his letter to shareholders. But just so you know, right, over the past 5 years, the China store count growth was 14%. Yeah, and compared to all others, which was 8% annually, and for the US only 2.2%. So what I'm trying to say with this is it has been a large growth factor for it. We know they have Luckin brands there, the Chinese consumer. I think, if I recall correctly, and I need to think deep now, I think Starbucks opened 778 stores last year, compared to several thousand by Luckin, and I think Luckin has now 16,483 stores or something like that right now. So this is, of course, the biggest competitor. And there was a really nice story on our Facebook group as well by one of our members who was in China and was doing the comparison and was going checking out Luckin and Starbucks and such. And he had some comforting news there that that yes, the consumer is weak in China, but that the Starbucks itself are quite good. So that's good to hear. We also know that the CEO's priority will be on the US, not on China. Maybe that's the reason why the stock is not doing anything. But I was a bit surprised because I do see Starbucks, if they get a stronger consumer out of this, also to get stronger numbers again.
Yeah, it's an interesting one because when I look at what China are trying to do, you would imagine that they would try and support their own company, this Luckin Coffee, over Starbucks and try and keep the money inside of China.
Yeah, but you can't force an individual to not go to Starbucks, right? Starbucks has still this appeal. It's an American brand. There are also many tourists in China.
Yeah. It's definitely an interesting one. I'm still not 100% sure, but look, I'm biased against Starbucks.
I don't have the same conviction on this stock. I'm quite happy with it. I don't like their balance sheet too much, but other than that, yeah, solid business for me.
Okay. And before we get on to Alibaba, which was part of one of our questions, there's probably one or two other companies that we could mention, such as Procter & Gamble or Unilever. Unilever actually have a whole page, which is a couple of thousand words long, in terms of their strategy in China and how it's their third biggest market at the moment, and how the growth there is important to their overall strategy. So it'll be interesting to see how those types of companies compare inside of China as well. As people have more money, they tend to spend that little bit more on the brands rather than go for the cheaper versions. So yeah, I think Unilever could see some benefit, not as much, I think, as Siemens or BASF or Louis Vuitton.
Louis Vuitton, yeah.
But there'll definitely be some kind of uptick from them. So I think you could look at some of your staples. Procter & Gamble have a large Chinese presence as well. So those two particular would benefit. But of course, Alibaba, what's your take on those?
Yeah, so Alibaba is very interesting when you think about it. Did you know that they bought back about 5.5% of their shares in the last 12 months?
No.
That's all because of the low share price that they had, or low, let's say, at the price that they were trading at.
Yeah.
Also, from a revenue point of view, they have a 10-year revenue CAGR of 32%, 5-year of 18%, and 3-year of 7%. So it clearly shows that the revenue was slowing down. What is for me interesting to see is now that the share price is above the 100 again slightly. It's there for the first time in a year. And also here over the last few days, of course, this skyrocketed this share price. Now, the question here was also like, can we get back to the fundamentals? What I would like to highlight is that they are not at the same net income level as they used to be during COVID. That was quite unique. And also free cash flow was really high, but over the last two years, it has been declining slightly, still much more than the net income. And yeah, that's clear also when you then look at the free cash flow that has been spent on share repurchases. They purchased more than that they were getting in free cash flow. Of course, I think it was a wise move to do that because it was trading at only a few PE multiple. So then the question is, can we start talking about fundamentals now again for China? And I would argue not so much, because I always had the feeling, and by the way, full disclosure, I own Alibaba shares, right? I bought them at an approximate, let's say, average price of, it must be 125. I don't know exactly. Yeah, so I'm still in the loss. But I always kept them because it was for me one of those in the tech side of the portfolio, this few percent that I reserve for non-dividend paying stocks, although it started paying a dividend now in the meanwhile. But the narrative was always about like, you can't trust the Chinese government. Also, their holding structure is not transparent, and da-di-da-di-da, da-di-da-di-da. Yeah. So who can check the books and all of this? So that was always the narrative. The narrative was never about the weaker consumer. So if this narrative will change, that Alibaba's structure and such is worthy again, then I think we will start talking about fundamentals. I think this is just a response to the overall boom, and it's a Chinese stock. So don't forget that many people are also buying Chinese ETFs right now, not necessarily single stocks. So yeah, this stock price had to go up on this news if all the other Chinese stocks go up. Whether we will start now start to see a story around Baba's valuation, I doubt it. I own it still because of its valuation. I am really happy with the share buybacks because I get much more of the profit, and eventually it will need to push it up, the share price. But I didn't hear the narrative changing over the last few weeks around Alibaba suddenly about the concerns about how the company is organized.
Yeah. Yeah, well, this is a clear example of diamond hands from people that have held it. It dropped significantly from about $300, if I remember, all the way down to 60. It gave a slight bounce up to 120 and started dropping again. The fundamentals, though, have always been strong.
Pretty good.
Yeah. It wasn't worthy of the drop that it certainly had in share price. But again, we had that uncertainty with management and cooking the books, and then also the China element to it. So it was a tough hold. But you would expect them to do relatively well out of this. If China recovers, you would expect the market to at least give it some respect, and it could offer you a chance to get out after. How long are you holding out? 3, 4 years?
3 years, 4 years. Yeah.
So
interesting. Actually, now that you say it, my hypothesis was always 3 years. So actually, I should now evaluate it, whether I need to sell it, because my hypothesis was that when I bought it at the price, that it would be around 250 to 300 right now. 250 was my target price for now. What's clearly not there. So maybe my money is better spent elsewhere. That's a good thought exercise for me. As you know, I've been putting less and less in this kind of technology part of the portfolio. It has done me well, right? Overall, Baba not, but Meta, for instance, I sold at $500 with an average price of, I don't know, 150 to 170. So, Google as well did also do me really well in this area. So Baba just not. But but I also need it less in my portfolio. I have less the urge to speculate on stocks like I had before. I have now much more the urge to just have quality compounders that have a safe dividend profile and that want to grow.
Yeah, and what helps is stories from our community, like Eric, who has recently got there, retired early.
Oh that I wanted to call out. We have got the third retired early member, right? Thank you for bringing that up. Really nice.
Yeah, so that helps to keep us on course and to stay away from all these.
And did you see a story?
Yes, of course,
yeah. It was really nice. So what was it? 2000, the tech bubble. He lost a lot.
Yeah.
Then the financial crisis. He was full in banks. He lost a lot.
Yeah.
Yet he retired 2 or 3 years ago, I believe. It's very inspiring to read that. It's all about progression and perseverance. But in the end, it's possible, and it seems to be very rewarding. So really nice to see. So congrats, Eric. When you're listening, congrats. Well done. We're proud of you.
Yeah, I love it. I love those stories, and to have the courage to stick with it after going broke twice. That's the second story we've had where people have gone broke twice and stuck it out and reached financial independence. So it's as I said, quite inspiring. Anyway, listeners' questions. We'll start there. Dividend Diary has asked the question. He said, if possible, can you share what your approach to a safety cushion is? How big is your cushion considering monthly expenses, and how do you manage it?
6 months. 6 months of emergency fund. That's it. And then the question is how I manage it. I put, let's say, 4 months in a deposit typically, and 2 months are hard cold cash readily available.
Yeah. I have roughly 3 months. As I get older, I'd probably increase that because I'm at an age now where I believe in the industry I work, it's not that difficult to get a job and you get a
Yeah.
good paying job. But as you get older,
Mhm.
at moments you'd have to revisit that. So I probably in 10 years from now probably aim to have that at 12 months, but
Yeah.
3 months right now is absolutely fine.
So I can tell you why it's 6 months for me. You've been at my place. I've got a relatively large house, so my expense bill will be also large if, for instance, I need to repair the roof or something like that.
Yeah.
So that's also why I'm having 6 months in there.
Next question is from MH79. What are your thoughts about Canadian companies? Are you already invested in some, or do you have any on your watch list?
I'm not invested. I have nothing on my watch list. It has to do with that it's again another market that I would need to study. I only hear good things about Canadian market, stock market. There seems to be really some jewels there for dividend growth stocks. I would really recommend to check out Mike, the dividend guy. He's a Canadian, has also a podcast, The Moose on the Loose, I believe. And he regularly talks about Canadian stocks.
Yeah, of course, we had Talk On, we had the Canadian investor as well. We've had
Exactly.
quite a few Canadian friends on this show. I have one, Brookfield Asset Management, BAM. I believe they are Canadian. I don't own them on the Canadian Stock Exchange, so I own them on the New York Stock Exchange because I already have US dollars. I don't have Canadian dollars, and it's just easier to keep track in my portfolio. So, like you, I think there's lots of good Canadian companies out there, but there's also lots of good European companies out there as well. And I have to say, recently that US estate tax has been on my mind. It's been mentioned quite a bit on Facebook, and I've done some research. It looks like Ireland has a treaty, and I would be all but exempt from that 60,000. But again, it's the uncertainty around that and the fact that that could change at any time. It's been really on my mind, and not just for myself. It's for my beneficiaries who'll get the money after me, obviously, because that's on my mind. So, yeah, I don't really want to add another complication to my portfolio.
Yeah.
Wim Mateus has asked us about an investment trust called Bankers. Before I even talk about them, what do you think they invest in?
Banks?
Nope. So I thought that originally as well when I saw them. They actually are the second longest dividend history for investment trusts. So they're just what's called a dividend hero. They have 57 years of dividend growth, which is just quite something. Their top holdings, get a load of this, is Microsoft 4.35%, Apple 3%, KLL Corp, American Express, Amazon, Broadcom, Alphabet, CME.
It's just a Nasdaq replacement.
Yeah, exactly. What I like about them is, now I haven't looked at them in depth, right? So I go onto this website called the AIC. It's brilliant for investment trusts, especially if you want to get a top level overview. And one thing it does give you is similar to the way we look for dividend policies in our own newsletter. They give you the objectives. So each investment trust has to give you their objective.
Yeah.
And they give it to you clearly. And they say, over the long term, the company aims to achieve capital growth in excess of the FTSE World Index and dividend growth greater than inflation. And they judge inflation by the UK Consumer Price Index. So that's exactly what you're going to get with these guys.
Yeah.
You're going to get, if you're living in the UK, you're getting dividend growth that's going to beat inflation, which is good for you. And you'll also get some capital growth as well. So look, I've already mentioned some of the core holdings they have. I think it's a really solid investment trust. Obviously, 57 years of dividend growth shows they have a strong track record. But like everything, you need to check their gearing. How much are they leveraging up? I didn't check that. And you also need to check their management. How long have they been in there? Is it due to change? If they do change, who's going to succeed? But yeah, it looks like definitely looks like one to consider, Wayne. Thank you for bringing
Nice.
that to our attention. Wolf of Harcourt Street, European DJI. Do you have any experience of InPost? Ticker symbol INPST.
Yeah, definitely. We've got one on the corner. It's amazing. It's really amazing, and I think many people in Poland are proud on this. Also on the founder of this company, the CEO of this company is, I would say, a celebrity. It's really simple. You order something, it goes to a deposit box, and you get like an SMS that it's ready or an email that it's ready. You get a code. You type in your phone number with the code. The lock opens, and you can take your parcel. It's as simple as that. The beauty of it is you don't need to be home. Yeah, so you have 48 hours to pick up the package, the parcel from this locker, and there's always one. If you live in a bit of a dense area, there's always one within a few hundred meters from you nowadays, at least where I live. So, and if it's full, you can go somewhere else in a few minutes by car. So it's really convenient because, in the past, they had to come to they came to your house, you weren't there, you couldn't open, you were at work or something like that. Very inconvenient. But this is so convenient, Derek. I mean, what they have done is just brilliant. It really nicely integrates also with the largest web shops that are here, like Allegro is a good one. Many people buy via Allegro. You get it the day later in InPost. And if you're another day around, that's okay. You take it the second day, or you send the code to someone else that picks it up for you. It's so convenient, Derek. I don't know if you have it in Ireland already, but this has been just a master stroke what they have built here.
Yeah, we have that in Ireland quite so, I'd say nearly over 10 years nearly at this stage. It was quite helpful in Ireland was when you were buying stuff on Amazon from the UK, they didn't deliver everything to Ireland. So you could get it delivered to Northern Ireland, which was part of the UK. And then they would bring it down from Northern Ireland and put it in one of these boxes for you to collect. And you go in and put in your PIN number. And it was, I think it was my parcel, I can't remember. But now on Post, we do it as well. But it's a clever business model. And as you said, it is quite convenient, especially for families that have maybe two parents working or the whole household working and kids in schooling are not there to collect parcels. It's really convenient. So, good business model. Lucien has asked us about Archer Daniel Mitchell, ADM. Do you see any moat in them?
I do see some moat in them, but wasn't this the company that was again having one of their presidents kind of cooking the books?
Yes.
I know they got over it. It seems to be isolated to that single event, but I mean, they have a whole movie after them from 20 years ago because of a big fraud. Yeah. So it does make me wonder, like, is there something structurally in this business that forces management to cook the numbers? I don't know.
Yeah. Of course, they have a strong dividend history, which is probably why this company keeps coming up. But yeah, I'm like that. Once there's fraud involved, I don't know. I haven't stayed too close to it. I don't know what has happened with that management team that has been involved. I'm sure they're gone, but yeah, I just tend to stay away. There's hundreds of companies out there that offer me better sleeping at night than having to deal with that. So yes, I think there is moat, but there's obviously other companies. Cisco is another company in that niche. Maybe that's what looking at. Cisco within S, not Cisco, the tech company. Pete Lee has asked us, and also Jean Christophe have asked us about oil and gas companies. So Pete has asked, are they attractive now for the long term? And Jean Christophe wants to challenge our conviction on these. And here's why. He said, point number one, there's no revenue growth. It's the same as it was 10 years ago. Point two, they are very cyclical. And point three, how can they grow dividend forever if there is no revenue growth?
So maybe first, Pete, so attractive depends on how you look at it. Yeah, I would say the yields are decent, and some of them have a safe dividend, like Chevron, ExxonMobil, Shell, I would argue. So if the yield is attractive enough for you, it might be attractive for the long term because you're a dividend growth investor. Yes. So the most important question is the dividend safe, and is the yield good enough for you? And then can the dividend grow in such a percentage that it is also meaningful growing going forward, right? So that you really benefit of the compounding. So if that all ticks the boxes, then yeah, they are probably attractive for Pete. Now, the challenge on this from the no revenue growth, I think what we've seen over the last 10 years has been a very difficult situation. In 2016, it was where the OPEC lost its full control, also with the US being more energy independent. So that hit the numbers a lot. Then, of course, we had COVID. I think it's picking up now again. But yeah, it is very cyclical. And we have seen the last 10 years, which were just really hard for oil and gas stocks. Yeah. Now, how they can grow, I think because they are very lowly valued. If you are having a Shell, let's say at a PE of 5 or 6, and they can massively buy back shares by what we've seen last year, I think even 8 or 9%. And that's where a lot of the dividend growth can come from. So if you then look at it, then yeah, it's not so much of a surprise, right? And then they acquire some companies here and there often, like they did with British Gas in 2016. So that's still how they can grow the dividends. But it's more like this kind of cigar butt idea, fueled therefore by a very low PE, which allows a lot to come from share buybacks as well.
Yeah. Yeah, it's been a tough ride for oil and gas companies over the last 10 years, but the question is, are they attractive now for the long term is really hard, particularly when we've both said it, it's very cyclical. And I think if you listen to the last maybe 20 or 30 episodes, I think at some point we've both said it, we would not be buying as much now as we did back in 2020. So I think you're bang on the money. It depends on your long-term view and where you view them right now. But yeah, I would struggle to buy them at this moment, if I'm honest.
And this is also what Jean-Christophe says, right? He says his concern is that you will have zero price appreciation and only will be collecting dividends at today's price. Yeah, that's a high likelihood, but that's not what happened to me. Let me quickly look at it. I have a 44% growth in Shell. So I've had my share price appreciation as well, and then I also see that I had tons of dividends, which are the dividends I received are almost 25% of my current value as well. So I've just earned tons of money on Shell, but again, I bought them at an average price of 20 euros. And they're now around 30.
So it was a lot easier at 20 to see some share price growth than it is now.
Share price growth, but it was harder to invest at 20s because at 20 everyone was massively selling shares, saying oil is dead. And now it's much more peaceful, and people are actually looking into it because they see the yields at 4% or 5%. At that time, it was much harder to acquire, and that's the difficulty of cyclicals. You really need to have a view of where this company should be throughout, let's say, the cycle. But it's hard for people to buy when the oil price goes to $30, $20. It's really, really hard.
Yeah, when there's blood on the streets, it is actually hard to buy. That's everyone says it, but it is hard to do. I get that, but I feel at that time it was different because we were in COVID, and everyone's saying it was dead because there was no planes in the sky, no cars on the road, and it just felt a little bit absurd. So yeah, look, I 100% understand your concern, Jean-Christophe, because as I said, I would struggle to buy at today's prices if I'm honest. Hugo has asked about the Phoenix Group. It's an insurance and wealth management company listed in London. Has this ever crossed your shortlist when looking up Chesnera or legal in general?
Yeah, that's what I actually wanted to mention because he thought that it's an alternative to legal in general, but it's actually a strong competitor of Chesnara, if you want to say it like that. Because what makes them special, the Phoenix Group, is that they are a life insurance company, right? But they specialize in the management and acquisition of closed life insurance and pension funds. This is what Chesnara does as well. They buy the portfolios of the other insurance companies. Yeah, and they try to still get some yield out of it. That's what they're doing it. So it really focuses on those runoff policies that are no longer sold to new customers, but still need to be managed for quite some time, actually. So therefore, it's really pretty much similar to Chesnara. I believe they have a yield of both 10%, but then I find the dividend growth consistency of Chesnara much better. They have been growing the dividends for 25 years or something like that, and Phoenix Group has had some bumps along the way.
Good. We've got a question from Seppo about Evolution AB. He's been looking at them and is quite impressed with them. But after digging, he has mentioned a company called Bettison AB. They could be an even better bet. And I believe Wolf of Harcourt Street brought them up when we spoke, when he spoke on the show about Evolution Gaming. And I can't quite remember, but they were in the same area, but slightly different niches as well. I think I believe Bettison would be a customer of Evolution if I'm remembering that correctly. They do have a decent dividend yield. I think their dividend policies to pay out about 50% of their earnings as well, which is in line with most of what we see in Europe. So they have a more European-based dividend policy. So yeah, it could be quite interesting to look into. I've never did a deep dive on them. I own Evolution. Honestly, I don't want to have too many gambling companies in my portfolio. So with the risk of being tempted, I will stay away and stick with Evolution for the time being.
Nice.
Marcus has asked us about Novo Nordisk. It's minus 20 in the last 3 months. Does this mean it's getting interesting for you yet?
No. I find it so expensive. There's so much growth anticipated in this company. So no, not yet. I think this company has found the miracle drug. They deserve a Nobel Prize for that, because many people, they probably feel more beautiful as an outcome of this, which is, and also I think it makes society healthier to have less fat people. But no, I don't see that the growth expectations are possible, but maybe it's just me not understanding that part well enough.
Yeah. And then last question goes to Harris, who's asked us about a company called Amdocs, ticker symbol DOX.
So I never heard of it, and I had to look into it. Maybe good to mention to our listeners. So it's a company that provides software and services to help actually communication and media companies manage for instance, their CRM, billing, and operations. So it typically works with phone and internet service providers, and then it helps with customer billing, customer service, managing the data. So interesting company. Kind of operating the administrative backend of those companies. And what really stood out to me is that the payout ratio is 41%. The dividend yield is on the low end, as Harris says, around 2.2%. But did you know that they doubled the dividend in the last 7 years? So that means they have like a 10% annual compounded growth rate, which makes it actually quite interesting for me to look one time a little bit deeper into it, because if I understand it really well, what their business is about, you and I know that you just don't replace a CRM just like that. Yeah. So once you're in, you're kind of there to stay for a very long time. If you're doing customer billing, believe me, you're not changing the system just like that, because the moment you do that and you screw up, there goes your revenue. Yeah.
Yeah.
So that's the nice thing about such a business description. This company may be very sticky. So it's ticker symbol DOX. I'm going to look into it. I'll put it on my list somewhere in the upcoming weeks.
Nice. Look forward to it. Yeah, I was thinking exactly that while you were speaking. I knew from the second you sat up while you were talking about the company that it had interested you. But CRM companies like this, as you just said, are quite sticky, hard to change. If you do change, there's big risks. So could be one to look for. Thank you, Harris. So that was the last question. Thanks to all our listeners again for your questions, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.